Welcome to the latest Motley Fool Scoreboard. I'm on Chocolate Balloon. We've got longtime fools, Jason Hall and Nick Sciple, giving a 1 to 10 rating to a top 200 company in the primary hidden gems database. It's TechnipFMC, ticker symbol FTI. It's a French company, so it might be TechnipFMC, but we'll go with Technip. First, we'll rate the strength of Technip's business, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Actually, Jason's got a 7. Nick, you've got an 8.
Yeah, it's surprising to see an 8 for an offshore energy supplier business, but Technip is kind of a unicorn. They've established themselves as a dominant player in integrated subsea equipment, and they built a competitive edge really from two separate innovations that their competitors haven't yet replicated. The first is called iEPCI, that's Integrated Engineering, Procurement, Construction, and Installation. It's where they'll bundle the hardware manufacturing of these components with the installation services under a single fixed price contract. Traditionally, you would have had one vendor build the subsea equipment, so think about trees, manifolds, control systems. Then you'd have a separate contractor go install all of that on the subsea floor. That creates some interface risk as you pass the ball from one supplier to another. If something goes wrong, the equipment supplier blames the installer, and vice versa. Technip's strategy has eliminated that by owning both pieces of the puzzle, which accelerates project timelines and reduces risk for operators. That strategy has resulted in 80% of their business now being direct rewarded to Technip rather than competitively bid. At the same time, they have scaled up a modular construction strategy they call Subsea 2.0. It's a configure-to-order product platform that standardizes that subsea hardware instead of custom engineering every component from scratch, which would require lead times of 9 to 12 months. They use standardized modules and can move straight from assembly to putting these things out into the market. That dramatically improves margins and reduces cycle times, though management says they're only a third of the way through the efficiency gains from this Subsea 2.0 strategy. So together, these two approaches create technological lock-in. Once operators commit to FTI's ecosystem for a field, switching costs become prohibitive over these multi-decade project life cycles that offshore oil and gas operate over. That said, this is still an offshore oil and gas exposed business, exposed to oil price cyclicality and geopolitical risks. For somebody operating in the energy services segment, about as defensible as you can get, but never going to be an invincible business operating in the offshore oil and gas industry.
I really focused on that part, Nick. You and I spent years together, fools that may not know, smashing our faces against the oil and gas industry. And I'm wearing an Enron shirt today, not because of concerns about fraud or anything like that, because it's a reminder of the realities of the downside. I rated a 7 here. I was tempted to go lower. I just don't want to grade on a curve. I agree with Nick. This is the best business in its industry, but it's a brutal cyclical industry. That vertically integrated, fully integrated model is certainly better. You know, it's really kind of like a one throat to choke kind of thing for its customers, but it's still leveraged to oil and gas CapEx spending patterns, and they are shackled to crude prices over the long term. And I think that just creates a lot of risk that investors need to be aware of. As Peter Lynch has told us, even the best at business in a mediocre industry is a mediocre business. And I think that that's the risk that we don't need to forget about here.
We like to say, oh, this business isn't going away. But if your customers do in a downturn, well, you're in some trouble.
Yeah.
For management, a 10 is Warren Buffett. A 1 is Homer Simpson. Both of you have 8s this time, Nick.
Yeah, so since joining the company in 2012, CEO Doug Pferdehirt has orchestrated a decade-long transformation that's repositioned TechnipFMC from a more cyclical service provider into this type of integrated technology platform that we talked about earlier. That's given the business more pricing power. It's delivered margin expansion. They've been able to return lots of capital to shareholders just over the past couple of years, more than $1.5 billion in cash returned to shareholders through dividends and buybacks. CEO's compensation is tied to return on invested capital and total shareholder returns, which we like. That said, it's not going to be like Buffett. This is one industry, one cycle, hasn't demonstrated the ability to invest capital across multiple domains. But at FMC, transforming that business over a decade plus, I think he's worthy of an 8.
Yeah, I came in with an 8 too, and I could be the cynic and say, hey, look, the stock is basically round-tripped under his tenure, but that's really unfair. You know, a couple years after coming in, the offshore industry basically collapsed. It was a brutal period. and you really, I think, grade what he did to keep the company afloat. And then since 2017, I believe is when the merger happened, everything that's happened since then that has created a tremendous amount of value, he has done an absolutely extraordinary job. Even if I gave him a 7 on his CEO work, he would be an 8 because he sounds a lot like Bill Mann. And that's, to me, that's bonus points.
That makes sense. Maybe an 8.5 next time, Jason.
There you go.
For financials, a 10 is a fortress, a 1 is yikes. Jason's at a 7. Nick, you're back at an 8.
Yeah, I'm at 8. They have a net cash position, over $400 million in cash. Their earliest debt maturities are at 2033 at sub 4% interest rates, and they're guiding for free cash flow between $1.3 billion and $1.45 billion for 2025. It's a really clean balance sheet and cash flow profile. If you look at their backlog, $16.8 billion. That's almost 2 years of revenue visibility, and margins continue to expand. They have as I mentioned earlier, this has been a capital return story. They have a $2.3 billion buyback authorization out in the market today. That's good for more than 10% of shares outstanding. Again, the only thing that holds this back from being a true fortress is some of the risk and capital intensity, execution risk embedded in these offshore contracts. Supply chain issues, vessel disruptions on large projects could impact the business's ability to generate cash and maintain those really strong financial profiles. But this is a really, really strong business, especially in the energy services category.
Yeah, I came in as a 7, a little bit lower here. I agree with Nick, but and Nick kind of hinted at it, but to say it explicitly, the balance sheet has to be strong, because if it's not strong, you're going to end up owned by your creditors. But even with that strong backlog you mentioned, Nick, 2 years is not long. And this is an industry that can go from feast to famine really quickly. It makes money when times are good, but a protracted period of low oil prices could cause those super majors and then the nationalized oil companies too, that those are its customers. If they pull back on future commitments, the market's going to look forward and see that backlog shrinking, and then it's going to start voting the stock price down. So there's a lot of risk that's kind of baked into the realities of this industry.
All right, Jason, let's talk valuation. How well will Technip stock go over the next 5 years now? Safe is it? 10's a sure thing, 1's a lottery ticket.
So one way to view me is to say that I'm just being very conservative. You could also say that I'm scarred from my previous battles with this industry, but 5 to 10% is my expectations here. Safety score of 5. I've just seen this play out across 2 major prior cycles offshore. We're in a really good period right now. Even with the oil price volatility we've seen over the past year, TechnipFMC has some very real advantages that Nick broke down really, really well. Management is absolutely taking advantage of it. They're eating like they're starving right now, because eventually they will be starving right now. But I think this is also potentially one of the more dangerous times to buy companies like this. We're at peak levels of profitability. Management is talking about profitability continuing to grow, and it could, but it also might not. We're also talking about back to all-time highs for the stock price. Again, I think management will continue executing well, but I just don't like the risk return profile from this valuation because of the realities of how quickly things can change with the cycle for demand.
Yeah, so I'm going to go a little bit spicier there on the return profile. So I went 5 to 10 year returns of 10 to 15% with a safety score of 7. As Jason pointed out, the stock just hit all-time highs. We're not exactly getting a bargain entry point here today. However, I think the margin expansion runway is real. I mentioned earlier that management says they're only through 1/3 of their efficiency gains from this Subsea 2.0 strategy, and some of their low-margin legacy contracts still rolling off the books. Buyback authorization I mentioned earlier provides a structural tailwind to earnings per share, even if revenue growth moderates. And I think the market is still underappreciating the durability of their $10 billion annual Subsea order target through 2030. They've delivered $10 billion in bookings the past couple years. They're expecting it this year in 2025 when they report fourth quarter earnings, have guided it for 2026, and expect to maintain that through the end of 2030. I know that doesn't sound that attractive, holding steady, but in these types of cyclical industries, sustaining peak activity for 5+ years is unusual and bullish, especially with this margin expansion they've been able to deliver. That safety score reflects this is a quality cyclical business with strong competitive positioning, but not immune to oil price shocks and geopolitical disruptions. If oil stays constructive and offshore investments continue. We just had a headline today about Chevron going to final investment decision in the Eastern Mediterranean. I think it's a constructive environment for TechnipFMC, and I think that the stock can perform over the next 5 years.
Thanks to both Nick and to Jason. They've given TechnipFMC a solid overall score of 7.1 out of 10. No top-its because Nick likes Technip's technology better than its competitors, and Jason doesn't like offshore unless things are very cheap and everyone's afraid of the space. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Abercrombie & Fitch. I assure you it'll be much shorter than this one. We had a lot of technical things we had to explain. Till then, Fool on.